I guess they will wait because one reading doesn't make the full deflationary phenomenon, right? So it's true that the reading was horrid, but it's a recession. What could we expect? And the question is indeed, the ECB can try to gain some time with the September and October reading. I don't expect them to move today, but I expect them to really calibrate their response by December, where we at Allianz expect them to actually increase QE by another 500 billion. So we do think that the dovish corner in which the Fed put the ECB on top of COVID, which basically put it back against the wall, is definitely there. But we don't think it's time yet to react. And remember, the inflation readings are also quite messed up by the VAT cut in Germany. And you have de facto a bit of a bizarre environment where investment cycles are on pause and savings are up. So I wouldn't give too much importance to this reading, but it definitely means, and we've seen that with the euro-dollar exchange rate, it definitely means that the ECB will have to do more, and that the ECB strategic review has to be fast-tracked so that the toolbox of the ECB is enriched to be able to address the growing concerns about hysteresis effect and deflation. Yeah.
What we've seen as the ECB has continued to raise the ante on this PEP program and QE, as you rightly describe it, we've seen the banking sector become more cautious, more careful, the loan officers pulling in their horns, reluctant to put the bank's balance sheet in a difficult position. Completely the opposite of what the ECB is actually hoping its scheme would achieve. So is the only way that the ECB can actually get the transmission mechanism to work better for the ECB to actually step into the market and start buying bank stocks at this point to provide a level of comfort to those banks about how their back is covered by the central bank?
Well, by 2030 or by 2040, I'm sure the ECB will have to do that. Right now, it's not really what is in the cards, but you're right to mention the banking sector. We estimated that COVID-19 related bad loans, so NPLs, non-performing loans, could rise as much by 300 billion. By 2021. So we are extremely concerned about the sole transmitters, because the market are not deep enough, of monetary policy in Europe, which are the banks. And you're right to say that the ECB has to basically enrich its toolbox again and enlarge a bit the toolkit to make sure that they address the growing concerns about a credit crunch stopping the recovery. And this is a much harder trick that whatever, the Fed on the other side of the pond is trying to do is, the Fed buying ETFs that are invested in German bonds. When you don't have direct access to the market, it's true that it makes it a bit more complicated. It's not just about closing the spread. It's about giving confidence to the banking sector. And of course, there is this, everlasting conversation about the bad bank, which we've heard so many times before. But I do think that TLTRO and all of those measures that are supposed to help the bank lend by relieving a bit the balance sheet are things that the ECB will have to look again into come 2021, because this is when we're going to see the reality of the COVID tsunami on the bank's balance sheets.